Hi, this is Randy Finney with the Right Side of the Chart, and this is a late session update for Thursday, February 13th, 2020. And what I want to do is look at the broad markets and some of the interrelated assets. Those would be so we'll look at the risk-on assets, which are stocks, so S&P 500 and NASDAQ 100. Maybe we'll hit on the Russell. And then a couple of the risk-off assets, such as Treasury bonds, gold, and some of the other precious metals. There's some things that stand out right now, some levels to watch: silver, platinum, things like that. So let's start here with the S&P 500 and talk about what's happened. This is SPY. So as I mentioned this morning, we broke down below those rising wedges right here. There's your breakdowns. These are showing just the regular session trades, and we've been back testing from below since. Sometimes you break down and drop, go from there, and quite often you'll have a breakdown, then you kick back to come in and back test or near back test of a wedge or a trend line from below. So this has been a tight back test, pretty steep uptrend line, pretty steep back testing, and that's really all it is now. The divergences are still intact as of this time. Market continues to have a voracious bid. The dip buyer stepped in, but again, let's just take it for what it is right now, and that's a breakdown and back test. Again, be very clear, throwing these out there as, potential trade ops for quick pullback trades, a counter trend, and I don't have anywhere near the confidence to add any of the index ETFs as swing trade official short trades right now. So I'm sharing the levels. Trade them as you like, whether you want to buy dips to these levels, whether you want to, stay where you are. I'll show you a couple other charts here, and then we're going to move on to some of the risk-off assets, because that actually, those go hand in hand quite often. And the way that I see things here is if we're going to get a decent correction, like the last one here, and the S&P 500 was 3.5%, the NASDAQ fell about 4%. If we're going to get anything like that, from the look of the charts, it's going to have to happen soon. These should play out. So that may or may not happen. Again, the trend has been strong. There's QQQ, same story, breakdown, back test. Back here we didn't get a back test. Sometimes you see a little bit of divergence between the S&P 500 and QQQ. So that was the breakdown there. Our initial sell signal followed through on the benefit of the doubt trend line, and again from high to low, the QQQ fell about 3.8, so we'll call it 4%. And you can see the first support level target down here is about a 1.75% drop. And if we come down here to what's still, for this next correction, whether it happens soon or a couple, week or two from now, about 4.25% to that preferred swing target down there at 224.70. That's the top of a gap, and as well as this very significant trend line I keep talking about off the October 3rd lows. It hasn't been visited in a little while. The last time we tagged it was right here, so I think that would be a place that buyers would be stepping in if we can get a correction. Now on the futures, NQ is still backtesting. ES is a little bit above it. This is NQ, the S&P, or no, gosh, sorry guys, the NASDAQ 100 futures. And if I don't make mention of which chart or time frame that I'm talking about, I try to do that. They're all up here on my charting platforms on the upper left-hand corner, as well as the what time frame we're working off of. An hourly candle. That means every candle is a 60-minute, represents 60 minutes of trading, or 1 hour. So that's it. The divergence is still intact on the back test. So breakdown back test, and it would be bullish if we go much above that trend line. Then really it just foils the whole pattern. But as I said, as of now, the breakdowns are still intact with the back testing going on, and we still have the divergences intact as well. Let's look at ES, and we'll move on to some other things here. ES. Like I said, ES is actually up above the trend line, depending on how you want to draw it. This is the draw I have right now on my ES 60-minute chart. And I'll show you the levels here. You have the lows right there, and a couple more reactions there, and a breakdown. Now, if I want to take that trend line and tighten it up and use these reactions here and just say that these were brief spikes because the candlestick bodies were still above there, that is certainly a valid trend line, and that gives you really the same story on NQ right now, which is a back test right there. So what you want to see ideally, if you did short today or plan to short or short it and you want to add on you probably want to wait to see a solid move down. I also mentioned this morning, if you were, I showed the breakdowns in pre-market, but I said you really want to see, give it the benefit of the doubt, wait till the market opens. Here's a 1-minute chart of QQQ, and this is just typical. The after anything that happens in after hours pre-market session. This is the daybreak line right here. So that's yesterday's after hours. Here's today's pre-market session. And you can see right here, we've kind of floundered around a bit. The breakdown happened last night. And then this morning, boom, as soon as the market opened, right here's the daybreak line. This is the shaded box is the after hours and pre-market session. The institution stepped in, and that's why I say, to be safe, you want to wait and see what happens, because a lot of times these after hours and pre-market trades and the futures and then in QQQ get reversed, and whether they're up or down. Not always. Sometimes they get built upon, but quite often they do get reversed. And that is the institutional players coming in, onto the market at 9:30 when there's a lot more liquidity, and they can buy in very large quantities in and out much more efficiently than they can in the thinly, traded after hours and pre-market session. We'll start out here with TLT. That is the 20 to 30 year, or what we call the long bond ETF. The long traded Treasury bonds, which go out to 30 years. It's surprising that TLT is holding up as much as it has. It's not surprising that we had this run. Back here we highlighted this symmetrical triangle pattern right there, and we had a breakout. So we got a thrust up, similar to what we had in gold. And TLT has been consolidating really between these levels here, about 146 and 141.70, and not far off its highs. And remember, when Treasury bonds go up or rally, that is usually due to one of two things: either concerns about the stock market. Again, this is the king of the risk-off assets. This is where particularly smart money or institutional traders will flock and move assets into when they want to be out of equities, whether the stock market has started to correcting or the really smart guys and gals foresee a correction. And then the other thing, of course, there's other factors in there: economic growth expectations, as well as inflation expectations, which usually go hand in hand. And those are the things that will control long-term rates. I don't have a strong read on this where we go from here right now. We're consolidating, and the charts aren't telling me a whole lot, but they are holding up, which does set something with the stock market, continuing to run at new highs like it has. This strong move here, you would normally expect to see treasuries down a whole lot more than they are. So I'm not seeing that today. And what my translation is, I'm taking this rally right now, at least especially at this point, with a big grain of salt, and leaning towards those pullback targets that I just mentioned being hit soon. This helps to support that case, although if you were to see treasuries all of a sudden start to sell off, that might not help the case there. There's a trend line support right there, and you can see some horizontal support levels. IEF, or your medium-term bonds, 7 to 10 years. There's a trend line to watch right there. And IEF is also near highs. And remember, interest rates, when these are the bond funds, so these reflect the prices of the bonds. When the price of a bond goes up, it means its interest rate is going down. They go inversely. So this means low rates. We're still at or near those multi-year or really all-time lows on interest rates right now, and that just it doesn't mesh with the surge we're seeing in equities, because again, this doesn't reflect strong future economic growth. What reflects strong economic growth, or when treasury bonds are dropping, I mean the interest rates are going up, because inflation and higher rates typically come with economic growth. And remember, the bond market and the stock market are forward-looking. So that's just something I wanted to point out. I don't see a lot here to want me to issue an active trade on the treasury bonds right now. If we broke that level, this is where the next support comes in right there. About 2% drop. It's not a whole lot. But as of now, I'm leaning towards those 60-minute charts playing out for correction very soon. I think that's probably start to see a reversal before the close today, or if not, if they ramp it into the close, or keep it up into the close maybe tomorrow. That's the way I'm leaning right now. Again, my convictions aren't high, and if that happens, you'll probably see TL or IEF, the 10-year Treasury bond, continue to work its way up and hold above this trend line right here. Junk bonds. That's something that I watch. I know a lot of smart money watches bond market, both treasuries and junk bonds for clues. You start to see cracks if you start to see junk bonds falling in price, meaning their yields are rising. That is often a red flag. Now, we're not seeing that right now, so this is at least by this. It doesn't mean the stock market can't correct. It just means right now junk bonds are actually holding up and trading near multi-year highs, or at least here, back their levels that they weren't trading at since early 2018. And they recently broke out. So here's what I'm watching on JNK, which is one of the two main junk bond ETFs. HYG is your other one. That's a big, big level to me, 109.18 right there. Call it 109-ish. And you can see we traded here in a range there. It was support back here. I could probably roll back farther. Yeah, we'll keep it right here. It was support. Once broken, became resistance, and it has been resistance for quite a while. So what you're looking at essentially is a breakout right here in junk bonds. It failed, but we're back above it, kind of slicing through the area a little bit lately. But again, there were a lot of reactions there, and should junk bonds drop, which I can almost assure you they will if the stock market corrects, that I can say is extremely likely. Junk bonds, by the way, have a much higher correlation, or historically have. Remember, the Fed has distorted almost every day. There's been tremendous distortions in decades old correlations between various asset classes and what the markets are doing, because this is the grand experiment. Quantitative easing, everything that they started with, flooding the markets with liquidity, trying to manipulate it with bond purchases, everything else, not just the Fed, all the central banks. So I just want to kind of throw that out there, that there's some things that aren't as accurate anymore. It's predicting things, but what I was getting at is, historically speaking, going back for many, many decades, junk bonds and equities, the stock market, have a much higher, almost a positive, almost a very tight positive correlation. Whereas Treasury bonds and all other bonds, investment grade bonds like LQD, these are your corporate bonds that are investment grade rated. JNK or junk bond, below investment grades. These are like treasuries. They tend to have an inverse correlation to the stock market, but you're not seeing that now either. You're seeing treasury bonds rallying with the stock market. So like I said, if I'm confusing you, there are some, again, quirky things. And then finally, I often say this: any two asset classes that have a correlation, whether it's a positive or an inverse correlation over time, there are always temporary disconnects where you don't see that, where they both may, if they have an inverse correlation, all of a sudden they both may rally together. And so from time to time that happens. So when I talk about historical correlations, that's where you want to go back to a weekly chart or monthly chart and go back decades and compare it. So what am I watching here? LQD. This is also I think potentially bearish for the market if this breaks. Here's an uptrend line off the lows. Pretty big divergences right here. The last time we had negative divergence was back here on LQD, and it led to a very sharp drop. It was a small divergences, small divergent high. This line, I don't even know why that one's there. That must have been marking a price channel at the time. Take that away. That is not a divergence line. Here are your divergence lines down here. Steep divergence, but small, led to a very sharp and relatively small pullback. It was for bonds, that's a pretty big drop. This is larger divergence that has been building since. In fact, it really started with that first divergent high right here. This is where that divergence starts, that continues today. We had divergence there. It did played out for a correction, but at that point, you can see these divergence lines continue. The indicators continue to make lower highs, while prices in LQD, the corporate bonds, quality investment grade corporate bonds, make higher highs. This isn't the best trend line. It's not the most well-defined trend line, but it's one to watch. An even more important level right there to me is at 128.36. If we break below there, that's going to show us that there's a lot of shift going on in the financial markets, and you'll also see junk bonds probably fall below that level. So these are levels to watch for bond traders. Now, It's hard for me to be bullish on bonds, like longer term bullish, because we're at historical lows. We're coming off near zero rates and interest rates. So there's really not a lot of upside. If you're a believer that we're going to go to a negative interest rate policy in the US, it's very possible. But again, it's like pushing on a string. You're not going to go to negative 10%. You go down to negative, below 1%, negative 1%, people are going to start putting their money on their mattress. So where I'm going with that is bonds virtually have no more upside. That's what I'm trying to say here. Yeah, they've broken out here, LQD, but due to the way interest rates and how bonds are directly related to the interest rates that they pay, as well as the credit quality of the issuer, there's very minimal. When I say virtually no more upside, I don't mean that LQD can't gain another 2-3% or even 5%, but that's probably about it. You have nothing but downside again when bonds are at a historical low interest, when interest rates are at a historical low. Here's the 30-year Treasury bond. You can roll back all the way into the 90s here, maybe even before that. Here, we'll go to a monthly chart. There you go. Here you want to see where interest rates have gone. This is the late 70s right here. Think Jimmy Carter, super high inflation, Reagan comes into office. That's where interest rates peak. So what you're looking at is a secular bear market in interest rates, but the floor, they're at or near the floor. And again, this is the long bond here. The Fed controls the short end of the curve directly via the federal funds rate, but they certainly have an influence on the longer term bond rates. So that's what I'm trying to say is there's really there's a floor here, and we're pretty much near that floor, and a lot of upside. Now we haven't even come close to reversing trend, so this it's not probably practical to go short bonds in hopes that we're going to see the rates anytime soon that we saw back in the late 70s or 80s. What we'll watch for certain things to see evidence of a trend reversal, but that's just not there yet. Kind of like the stock market as far as the primary trend right now. Please don't be confused when I cover short-term analysis, intraday charts like a 60-minute time frame, looking for pullback trades. Don't confuse that with a 50% bear market or anything like that. One of these little 60-minute tops will eventually prove to be the top, but I'm not going to spend time doing my long-term analysis because I've covered that in the past. There's quite a few primary trend lines on QQQ and SPY, and some long-term trend indicators I use that we're still well above now, and we're not even close to those. If and when those longer-term trend indicators, we start to get close to them, I will turn my focus back to these weekly and monthly charts. But as of now, like I said, that's one of them right there, this 20-month EMA right there. That's when we start to see, and this was a stick save right here, as we had a couple stick saves back here in 2015. But other than that, this little single line right there, the 20-month EMA, has done a stellar job of defining the bull and bear markets in the past, both again, bull and bear trends. This was a 2007 top, went below it, back tested, boom. And so it told you throughout the bulk, not all, but most of that bear market, that's what you were in. So again, I don't want to digress. Let's go back to the other things I wanted to cover, which are gold, GLD. Gold, I continue to maintain and have for a while. I still think it's in a bull. Well, you can argue with me on where I think it's going, but you can't argue that it's not in a bull market, because that it is. Gold bottomed back all the way in 2016, December of 2016, right here, and it has been moving steadily higher since, making a series of higher highs and higher lows, and that is the definition of an uptrend. The fact that it's gained more than 20% gives it the definition of a bull market. It's up, about 50% off those lows. So that's where we're at. Long-term chart still constructive. This is my weekly chart. You had was very bullish when we broke out of that downtrend line. The symmetrical triangle here, highlighted back at the time. Breakdown back test went up here. Had a consolidation correction, which is at the time I said it's typical bull market. Action. Nothing goes up forever. You have to consolidate along the way, have little corrections, and we broke out. But more importantly, here's what I'm seeing, and this is what I wanted to point out. As I just showed you, the stock market has been, I don't want to say ripping, but just steadily advancing for weeks now and even months, and yet gold is not far off the all-time highs either. So this is showing me there are a lot of money being put into gold and kept in there. In other words, they're not taking profits. They're not those that are holding gold, whether it's smart money, dumb money, a combination of both. Undoubtedly, I'm sure it's a little of each. They're holding on to that because they suspect the writing is on the wall. This is by far the longest bull market in history. But again, let's go over near-term stuff right now. So near-term. I don't have a very strong opinion on gold. We had a minor uptrend line here. It broke. It's been dancing above this. This is 147 was that previous reaction high. It's kind of cut through there. So let me give you another level to watch, and then I'm going to give you a few other charts to look at. So if the stock market were to break down and correct soon, let's say it's at 4 to 5% plus correction like those recent corrections we had, gold's probably going to take another leg up. And as I just said, I'm leaning that way now, that we're probably looking at something here in the next week or so, the start of that, probably sooner in the next few days here, the start of that next pullback. And so that should help gold. I just can't make a very strong case, but what I've been saying for a long time, I think it makes sense to have, and have for a while, piece of that as a part of your portfolio into precious metals, particularly gold, silver, some gold mining stocks, things like that. And as we look at the 60-minute chart here, you can see the gold's kind of just been chopping around. And that's also why I haven't done a lot of updates. There's, if I don't see a whole lot on a security, I may cover gold day in, day out, videos, gold mining stocks, silver, platinum, palladium, and then all of a sudden, as you guys know, I'll just kind of back off it because there's nothing there. I'm not going to, waste time covering security that I don't have any idea where it's going in the near term, or do the charts indicate that it's set up clearly bullish or bearish. There are things like this. You can trade little minor trend lines and game these little things, but gold doesn't move that much. You really have to leverage up to trade it effectively there and make enough to make it worthwhile. What does concern me a little bit, let me turn off all these lines and give you just a clean board, and something that I should point out. Said I'm bullish on gold, but what I don't like about it right now is this negative divergence. You can see as I'm drawing it out here. There's gold prices making higher highs since this point, and the indicators making lower highs or negative divergence. That doesn't have to play out for correction. As I often say, negative divergence is not a sell signal. It's merely an indication of that a trend reversal is likely. And then you need to see a sell signal. You can also think of it this way. I've pointed out many divergences in the stock market on the daily chart for months now, even the last couple of years. Most of those have played out, but some of those have been burned through. So when something is in a bullish trend, it can burn through divergences. By that I mean it comes up, the indicators eventually go up and take out those previous highs. And there's a great example. The stock market did it here. Well, maybe not so much on SPY. Did we do it there? No, we didn't. QQQ has. There's an example right there. See this PPO right here? I put a line there. It's above this point here. So we had divergence up until about right here recently. That was taken out, burned through, at least here on the PPO by a slight amount. Not so much on the RSI because we're still at or just below this previous peak right there. But I just want to throw that out. And now let's look at a few other things. And I do want to get to the futures. So since we're talking about gold, let's keep it consistent here and look at GC gold futures for gold traders. Here are some trend lines to watch. I'm on a 60-minute time frame, and you can see the levels marked up. We had a divergent high right here, negative divergence. You can see the divergences down here. Boom, that was a correction. We put in another divergent high right here, corrections. So this is why divergences are a big part of my trading, positive or negative. Positive divergences are bullish. These negative divergences are bearish. But that correction's played out, maybe for enough, maybe not. Here's a potential trend line right here. It was an active trend line there, but we haven't visited that in a while. So while I'm sharing this, I can see a little bit more here on this chart of gold futures. I can see that 1580 is a pretty decent resistance level, and that's what we're pushing up here. So I'm just highlighting the reactions, the gaps, everything that happened around there. So if the stock market, if these divergences and those wedge breakdowns I highlighted today start to play out, we'll probably see this, boom, pop above 1580, and I can tell you this, if you're an active trader, you can go long with a stop somewhat below, probably below this little minor uptrend line, and see how far gold can go. I don't have high convictions. I don't have a solid price target for you, but I'd say you could probably target at least this previous reaction high, and possibly that other one up there. Or just let it go. Maybe gold's about to take off to the next leg up. I talked about that quite a bit recently. Back here on the daily chart when we broke out of that, go back here, that symmetrical triangle pattern. That's the blue lines here. It was similar to TLT. So back here we were tracking this. We had a clean downtrend line and an uptrend line right there. Those two blue lines formed a symmetrical triangle. Breakout right there, and boom, a rip. So this was, as I said at the time, believed to be just a corrective phase consolidation period in an ongoing bull market, and that was, likely the catalyst for the next thrust up. However, we've been consolidating again. It doesn't surprise me with the strength in the stock market. And that's the point I'm trying to make. You would think that with that rally we've had in the stock market in recent weeks, that gold would have been rejected off that previous high, and it has not been. So this is good relative strength, and so it's possible we get that next leg up soon. And again, trade it as you want. If I get some higher convictions, maybe I'll add this again as an official trade. But it's kind of been an unofficial long-term trade all along, as I've been talking and walking it up, talking and going over gold on the way up, pointing out when the corrections were likely and levels to buy back in, pullbacks to support, that kind of good stuff. All right, silver. Silver, similar story. Silver is going to follow its big brother, gold. There's a pullback there to a pretty decent support, that 1632 level right there. And right here we're at 1632. It's acted as resistance quite a bit back here. And, it's been kind of moving through support and resistance levels, so not the best, chart to work off of because of this volatile price action. But again, if gold's in a longer-term bull market with another leg up to come, silver probably is as well. It's just a matter of we're going to get another pullback first and down to any of these support levels. And if so, I think it's going to depend on what the stock market does. If it doesn't correct now, if it's got a couple more weeks to run, then I wouldn't expect gold and silver to go too far. This one I like. This is the silver 60-minute chart. SI is the symbol for silver futures. You look at, you have a nice, clean, well-defined downtrend line. That's why I color-coded it yellow. And you have a very nice support here, about 1736 right there. And you also have, I put a minor support line just below it right here. So this forms, these blue lines I just drew, form a descending triangle pattern, we call this in technical analysis. And these guys can break either way, but if it breaks to the upside, you want to look for these previous reaction highs as potential targets or resistance levels. But I think silver could work its way back up here to that 115 level. It's pretty decent resistance. There's a big gap right here. A lot of resistance levels or reactions off that level there and all the way back here as well. Obviously bullish if it can go on through there. And of course, if it breaks here, bearish, and you can see the resistance level or support levels below that could come into play and should come into play. But if it breaks all that, not good. This scenario, a bigger drop in silver or gold coming up anytime soon would most likely coincide with just a blow off top in the market. The market keeps going up, maybe starts going parabolic. That wouldn't be so good for gold and silver, or shouldn't be, but who knows. It's been going up lately, and they've kind of been hanging in there. Again, we call this relative strength. They're not going up, or at least silver's not going up as much. But I showed you the gold's not far off its all-time highs, and so you're not seeing money coming out of the risk-off assets as you might normally during a stock market rally. The other ones I wanted to mention here are platinum. And let me pull that chart. PPLT is a platinum ETF. Here's a nice trend line that's working its way up. It's pulled back to support. I have support around $90 right here. I'll round that off. Everybody loves round numbers. $90 is decent support. You can see going back here. Quite a few reactions on that level. And then below that you have trend line support as well as a couple price support levels. So the trend line, we can move it around. That's probably about the best fit right about here, somewhere in there. So, a case could be made to step in, but let me show you the charts of platinum futures here. All right, so here's a similar downtrend line right here, and you can see a breakout. Again, platinum's probably not going to run too far without gold and silver rallying as well. This is one of the precious metals, but there's a breakout. It depends how you draw the trend line, but I think that's a pretty decent fit. So at this point, it did break the trend line resistance, but it also needs to break. It has some price support right about here. And what I'm looking at there, if you're wondering how I come up with these levels, I'm looking at the all the reactions around that level, particularly the most recent reactions. Those are, you always put a higher weighting on the more recent reactions than older reactions. But if you can go back in time and you see, that's where that level capped all advances before, it comes into play. It helps to validate 978 or so as resistance. So therefore, a pop above 978, call it 980, should open the door for move up here to about 998. That would be a decent rally on platinum. Likewise, you can see support levels down below. If the breakout fails and we drop below these levels, particularly that 952 level right here, this one I can't round these numbers off on this charting platform. Unfortunately, I can only drag the line around and try to snap it to 952, but it's not going to do that. So that's it. Palladium, I'll mention that. We still, like I said, you're not going to see palladium. Most likely, you won't see a major top in palladium till the stock market tops. This has been trading largely in line with the stock market based on economic growth expectations. If the automakers are still pumping out cars because the stock market's ripping to new highs and everybody has jobs, everybody's 401ks are flush, they're going to buy cars. Cars need palladium for the catalytic converters and the emissions controls, and there's been a shortage of that. However, I'm still looking at the potential for a major top and a huge bear market. This will be one of my favorite or biggest positions when we finally have some decent evidence of a top as far as a swing trade, that I tuck away for 50% or more drop. Again, I've covered the charts of palladium in the past, and it's cyclical. So is platinum, so are a lot of the metals. But this one, the cyclical swings from top to bottom are very large. You can get more bang for your buck going long or short palladium normally than you will on trading gold. That's it. Let me wrap it up here. No, I'd be remiss, and I will wrap it up after this. I thought we were going to see more of a rally in the euro recently, and that we didn't. And now I'm going to say this too. So I was wrong on where I thought the dollar and the euro was going. I'd like to use EUR USD as a proxy. EUR USD is the euro US dollar forex pair, and you can see we had this breakout of the primary downtrend line. Breakout down here, divergent low, looked very constructive. I mean, the long-term chart looked like a major bottom was in, and it still may be. I mean, that's why I wanted to go over here. This was a support level I had for a while here, 108, 523 or so, and we're falling down there right now. The divergence is still very much intact. So the same case that I've been making for months now can still be made for a major bottom in the euro, which would correlate to a major top in the dollar. Why am I talking about that? Because the US dollar and gold typically have a very, very strong inverse correlation. Again, you go back decades, and it's simple. When the dollar goes up in value, the rising dollar means it takes fewer dollars to buy an ounce of gold. Therefore, the price of gold is going to drop. When the dollar falls, it takes more dollars to buy an ounce of gold, so the price of gold is going to go up. So this is another factor, probably one of the biggest factors on the price of gold. However, I'm going to go back to we'll look at the US dollar ETF. You guys can trade this on any charting platform or track it. This is UUP, the US dollar ETF. This is a weekly chart. Again, it appears to me that the dollar is at or near, a major top, may have already topped. So yeah, I may be proven right. Like back here, I said that I think that we might have dropped, and so far we're still off that, and we're making this series of lower lows. That is the definition of a downtrend. It's only one early in the, early in with just a few lower highs, but so far that is the makings of a downtrend, lower highs and lower lows. And I still think the charts are indicative that we could see a major top in the dollar. And if so, again, falling dollar should be bullish for gold. And what I wanted to say is recently the dollar has had a strong snapback rally. The dollar's rallied pretty hard here. That's a pretty decent move. And yet gold hasn't fallen that much. So that is, again, another indication that gold's holding up relatively well despite the rally in the stock market and despite the rally in the US dollar. I wish I could see something in the charts that a very solid support level at which to buy it on now, or a breakout, a very clear, well-defined bullish chart pattern. And if so, I might add it. But again, I wanted to just do that update because I know a lot of you have positions in gold or like to trade in and out of it, or the gold mining stocks. I'm not going to cover now those in this video. I can only tell you that GDX will follow gold. There are times of temporary disconnects, but if gold goes up 10%, GDX is going to go up 15 or 20. If gold drops 20%, GDX will drop 30, 40, or 50%. It's that simple. It's just like trading a leverage play on gold. So, if I'm bullish on gold longer term, typically I'm going to be bullish on the miners too. And so these are the levels to look at. You can see the dollar at resistance now. So that also helps mesh with a pop in gold here. If the stock market corrects and the dollar reverses off this level right here, that should be a catalyst for a rally in gold. And I told you I think you get more bang for your buck. I'll leave it at this with silver because there's a very well-defined trend line, and silver tends to rip at times and outperform gold. Not always, but there are times. Sometimes it underperforms, but if it does break out here, you can see the levels right there and some potential targets. All right, we'll wrap it up here. Get this out to you guys, and if I see anything else, I'll follow up before the close. This has been Randy Finney with the Right Side of the Chart. I hope you enjoyed it.